What if I told you that the bank crisis wasn't over? In fact, it's getting worse. The information I'm going to show you today is going to highlight where the money has gone to. My name is David Quintieri, and I have been looking into this information for well over a decade and bringing out these YouTube videos every single day. There's nobody that's been in the game doing this as long as I have at this level of depth. So you watch these videos, you get the condensed knowledge. I spend the hours a day and you get it in 10-15 minutes. That's what we're going to do today. You came here for the truth, so let me unveil that for you. Look, it is worse than we had expected it would be for those inside the financial system. You got one, Jamie Dimon, warning them panic will overtake markets as US approaches debt default. He has said this. Your friend Janet Yellen, you've got Jerome Powell, and others out there who have basically said the same thing, that all of this is going to intensify. And why do we believe this? It's because all of the actions that have been taken with the bank crisis as well as the debt crisis are all converging right now at the same time. You can't get away from this. Interest rates are higher than what the markets are willing to accept. And the belief is that in 2023, there's going to be 75 basis points, that's 0.75% rate cuts taking place this year, 2023. Well, we're almost at about halfway through the year, and according to, I'll show you in a second, the Federal Reserve, they're saying absolutely not. The market is priced to perfection. Now, you've got something to worry about it if you are overexposed at this moment. US Treasury yields will rise significantly over the coming month, according to analysts who were split over whether the risk of a US default was higher at the same as prior standoffs over the debt ceiling. Because you look back in recent years, we have seen this before, maybe 2011, maybe some other points where, we've seen kind of similar activities. And what happened? Well, in the end, of course, they decided that they want to pump more money into the system, but it usually comes with a battle, and we'll see what happens this time around. But in the meantime, we are seeing those treasury yields rising. The markets are getting real topsy-turvy right now, let me tell you. Okay. So in connection with that, you look at what the Federal Reserve said. Now, this is the Fed Governor, Philip Jefferson. He is just as serious about the central bank's goal of full employment as about its mandate for stable prices. Check this out, quote, "I care very much about how the labor market performs because for most people in the US economy, their standing in the labor market will very much determine their station in life." So that's something I'm very mindful of. But I'm also aware that inflation is the most insidious of social diseases, and so it's important to try to get that down. Basically saying that we have to keep interest rates high for longer. That's what they're experiencing right now in each and every one of their meetings. They bring that out, and I have given that to you. I've shown you each and every one of their meetings and their statements here on this channel. If you want to be aware of that, just simply hit that thumbs up button, and it's more likely to come up in your, your searches, your home feed, or you can simply subscribe to the channel, because each and every day I bring you this, the latest and greatest. What he's saying here is that they want to tamp down inflation, and in order to do that, interest rates need to be elevated. The problem here is that we have a disparity in between what the market believes and what they're actually doing and saying. So there's a grand disparity that's going on right here. Now, if we flip over to what's happening with the banks, I think it is probably something we should be paying attention to, okay? Look at this, deposits. Change since January 2021, where those were increasing to some degree in percentage terms. And then you looked at that. Small banks were roughly okay up until we got into the later part of 2022. And if you look at that peak, it really is within 2022, and it's just been declining ever since. Now, a lot happened during this period of time, so much in fact. And one of those things has been interest rates. Okay, big change in interest rates in early 2022. This is just splitting up with small banks, all banks, and large banks. But I think it is clear that, first of all, we have seen a continuation of the decline. And why? Why would somebody put their money into a regular bank? Number one, you've got the crisis happening. They don't trust it. Okay, FDIC, they don't trust it. If you're in Canada, CDIC, they don't trust it. Okay, no matter where you are. And so you look at it and look at it at another level. What has been going on? Do you know? I'm sure you do if you've been watching this channel. It's that interest rates have been rising. So suddenly, people were just keeping, oh, just keep it in the bank. I'm not going to lose anything or lose to inflation, but I'm not going to lose my money. And as soon as interest rates started to rise, people started to put their money into other places. So that's where that trend really lies. But as soon as SVB started to collapse, this intensified. That's what we're seeing here in this chart. And so there's a lot happening. Market's really wild. I mean, it's crazy. So that's what we'll talk about in this right here. You could see it for yourself. Deposits declining significantly. You could, compare that at the bottom as well as just the rate of change. Earlier, we saw the intensification with SVB, Signature, Credit Suisse, one after the other, and that hasn't stopped. So there will be more banks that fail. And you could look at this here, just comparing. I just wanted to show this to you. I think I covered in the previous video, and if I, made a mistake in the way I was suggesting it, I just wanted to be clear, and I'll show you this again. Money market funds are seeing all of the money that's basically leaving. I know it shows you up, but that's essentially the deposits that are going down. Okay, it's an inverse. And so while deposits are going down, people are putting their money into money market funds. These two things are happening simultaneously, and people are deciding to put their money in. They want to deploy that cash, but at the same time, they don't trust their bank. Okay, so they want it liquid, they want it ready to go, ready to deploy, but they don't trust the banks. And so that's what we're seeing here. And I just wanted to make that very clear. That's where money's going. They're seeing billions and billions. So here we go. Of course, with all of this, at the same time, regional banks are getting absolutely slaughtered, continuing to happen right here. At the same time, the cost to insure against the US default. So basically, these are CDS, credit default swaps. And credit default swaps, you could think of it in different ways as like insurance against a failure of something, or a bet that something will fail. Either way, that is way higher. Like this is financial crisis. This is now way higher than all of the events, including the financial crisis. Much higher than that. Isn't that strange? Isn't that so unusual? Way higher, in fact. But it seems like we're living through it right now. It seems like it's we've been here before, okay, we can handle it. But in terms of the CDS, credit default swaps, it's showing some wild volatility, does it not? Okay, look here. You could see the import price index, export price declining, both of these declining over the last little while. I mean, it just shows us that we have a reduction. Some would say this is a reduction in inflation. We could look at this as well, connect it in with it, which is basically just mirroring the same thing from before, from the prices. But at the same time, we are watching the China credit impulse. Okay, so I wanted to bring this together. China credit impulse is one of the most important indicators. I don't see too many others out there covering it because it's a little bit more obscure. Now, what you can take from the China credit impulse, by the way, I've been covering this for many years and I show you it as often as I possibly can. Think of that like the amount of money, amount of loans that are being put into the financial system in China. And so that has like this effect where if money goes through, like the China credit impulse is increasing, for instance, that's inflationary. And eventually it makes its way around the world. And so if it's going down as it was in the years prior, lockdowns, business activity slowed down, all that thing brought that down, you have a reduction in inflation or perhaps deflation. So now we're seeing the reverse of that. Now, over the last few months, it's kind of been a bit up and down, but in general, we have seen that going up. Now, what has happened over this period is that China has loosened their lending restrictions, the reserve requirements, like everything is just like, hey, loan out money, send that off. We need to stimulate. At the same time, everyone else has been tightening. So it goes in the complete inverse of the rest of the world. Very unusual, and I just want to show that to you, that China is doing one thing, rest of the world doing another. Very important to see that distinction there. When we look at and when we make generalizations, we got to be mindful. PPI, Producer Price Index, has declined down. You could see that as well here. All I'm trying to show you is that for some of these things, that's great, but some would say that signals a major deflation. And another one that does that is this, M2. So think about this like, money in circulation. That has been declining, or at least we could, I think the more proper way to say this is the total expansion of the money supply has been declining. Does that make sense to you? Clear as mud? What it means is this is like a year-over-year figure. It's not like total dollar value. And so, yeah, they pumped in so much cash in 2020 and afterwards, but lately they haven't been expanding. So therefore that has come down. But the truth is the system needs constant expansion and stimulus in order to actually improve or grow. And if it doesn't get that, it's a big problem. So that's what we're seeing right now. So it is a concern, but let's be very clear about it. It's not as if the money supply is falling down. It's the growth is falling, if that makes any sense, okay? And then we have this initial jobless claims. I just want to highlight that more people are taking this on since the last, several months, in fact. So the employment situation is it's done on purpose, obviously, to make people think that everything is A-okay, and yet here we are, right? Okay, so that's really the next thing. I wanted to show you this video because it gets into the next aspects of this. You got to click on this video so I can give you the next part of this, these details highlighted in this video. Check it out, click there, and I'll see you there.